Jimmy Lee, the S&P's up around 1% so far this year, but it's getting very choppy out there. Where do we go from here?
Well, I think we might have a little bit of upside left technically, but at 2,200 or so, if we get that high in S&P, I think we have the potential for the equilibrium of sellers to overcome the buyers and a lot of pressure then. And I'm really concerned about this potential trifecta of Greece, what's going on in Cuba, and what's going on in China. Maybe all of those together is a recipe for the correction that everybody's been waiting for a long time.
So how should investors protect themselves if they're going to get hit as you see it? Should they buy puts, sell calls, go to cash? What should they do?
I think probably the easiest strategy is to raise some cash, have some dry powder to maybe buy on some of these dips and wait out to see how deep the correction might actually be. If you're sophisticated enough to put some puts or use some option strategies, that's another way to do it. We actually use inverse positions to offset the remaining equities in our portfolio. So there's lots of different ways to do it. I think that investors should talk to their advisor or come up with a strategy that was comfortable for them.
If they are going to buy the dips, which sectors should they buy the dips in?
We like healthcare. We're still overweight on healthcare, and I think that in a defensive style of a market, I think that getting dividends out of healthcare stocks and in general with all the activity with M&A potential in healthcare, that's a good place to be. Also consumer staples. We're leaving the mid and entering the late cycle of this business cycle that we're in, and those types of stocks tend to work really well in that time frame.
Now you also see inflation popping up in the economy. We didn't see it in wages in the June jobs number. So when's it going to hit? How is the Fed going to react? And what does that mean for stocks?
Okay, so here's what's going on. I think that we have a political push in this country to raise minimum wages. Eventually, companies that have pricing power are going to have to raise prices to keep their profit margins healthy the way they want it to be. That's going to put pressure on inflation that might be a little higher than what people expect, and also pressure on long-term interest rates. It will also give the Fed another reason to justify raising the Fed rate.
All right, and then what should people do with their bond portfolios if this is your outlook?
That's a big concern for us, Greg, because with the prospects of rising interest rates, and also what we're talking to a lot of our bond managers about is the lack of liquidity. If there's a sell-off and there's a panic, a lot of the bond managers that we're talking to are getting lines of credit, to make sure that they can meet redemption. So the fixed income area, I think that investors could think about alternatives, maybe even buying equity producing or income producing equities as an alternative.
So like dividends?
Absolutely.
All right, what about REITs and preferreds? I mean, you got to find yield somewhere.
Real estate, you got to be very careful because I think that in most places, in most sectors, real estate is fairly valued or maybe even expensive. So I think you have to be careful there. But we've used some private debt products, private debt lending that actually interest rates are floating, so the loans are floating and can work well in a rising rate environment.
All right, well, thanks a lot for coming on.
Thank you, Greg.
Thank you for watching The Street.